Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In this video, I'm going to show you why we are currently experiencing, from a macro standpoint, a perfect trifecta of indicators that have an incredible track record at predicting that there are going to be very tough times ahead of us. We're going to be looking at what that means for the market, what that means for the labor market as well, and of course what we can actually do about it. If you are new here, don't forget to smash that subscribe button. We make these types of videos multiple times a week, covering the stock market, the economy, and any opportunities that we may see. And if you enjoyed this video, don't forget to support the channel by clicking on that like button. Now, without further ado, let's get right into it. This is the first chart that I wanted to show you guys. You can see this indicator is incredibly accurate at timing tops and bottoms in the market. Of course, I am kidding. We need to zoom in a little bit more to understand what this indicator actually is. It's a very messy chart that changes up and down every single day. What it basically is, it's the SP 500 down pressure, and each of these readings basically represents the selling pressure that you have on any given day. Now, what it essentially calculates is the number of down points that you're seeing on the SP 500 on a given day, and averaging that with the total down volume that you have on the SP 500. So how much the market is moving down, and also what selling volume you're seeing on that same day. And why am I showing you this? You can see it's a very messy chart when you zoom out to 2002. But here, if we put a 150-day moving average on this indicator, it changes the entire story. This is what this indicator looks like when it's smoothened out. When you put a 150 period moving average on this indicator, it shows you what type of behavior you've had in the market throughout the last 150 days. And you can see the selling pressure that we've had in the market throughout 2022 here is sky high. We haven't seen anything like this since 2008. And before that, the 2000 bear market. Unfortunately, we don't have data that goes back to the 2000 bear market. So let's try and understand this data from a very quantitative standpoint. And what do I mean by quantitative? I mean very objectively, just looking at the data, just looking at the numbers and what it typically means for the market that we see so much SP 500 down pressure. Is it bullish? Is it bearish? Does it actually mean anything? So what we're going to look at here is every time that this moving average crosses above the 0.5 level, which is around here, you can see it happen a few times. So I want to look at how many times we've seen this, and these are essentially the results. You can see we had this reading right here in June of 2022, in 2015, 2012, 2011, and 2008. Now you can see a lot of these actually correspond to bottoms. You can see 2011, that was a bottom. 2012, that was a bottom. 2015, that was a bottom. And arguably June of 2022 was also some kind of a bottom. The market bounced significantly, and we are around that same level since we've had that reading. Of course, if you were on gameoftrades.net back in June, you would have timed that bottom beautifully, as market internals were at their most oversold levels since COVID-19. But what is more concerning about this data set is that we also have 2008 right here, where the S&P 500 down pressure actually reached the same levels as these bottoms right here, these bull market bottoms. But in 2008, that was only the very beginning of the bear market, and the macro environment was going to lead the market down in the year after that reading. Now, what is concerning about this chart is that in these examples, when downwards pressure hit that level, that was at the market bottom. In 2012 again, and in 2011, that was perfectly at the market bottom. If we look at the reading we had in 2022, not only was it not at the June bottom, but it wasn't even at the real bottom. The bottom actually occurred in October of 2022. So that actually looks a lot more like the selling pressure that we had in 2008 leading up to the big crash. But the point I'm trying to highlight here is that the only reason the market continued to move down, despite the fact that we had already reached extreme selling pressure, was because of the macro environment. In these cases, 2011 and 2015, the macro environment was great. Here in 2008, we were heading right into a recession. So the next question is, are we actually heading into a recession right now? Perhaps not a global financial crisis like 2008, but are we heading towards a recession? Now, let me give you the classic reminder. The yield curve is inverted, right? Every single time it has inverted. In the past, it has led to recessions. and the unemployment rate rising along with that recession. You can see that very clearly on this chart. There's no need to prove that out. But what if the yield curve is not enough to say we are in a recession? We need more evidence than that. So let me talk to you about that perfect trifecta that I was mentioning earlier. And for that, instead of looking at the bond market, right, the yield curve is essentially the bond market predicting the recession. We have to look at PMIs. Now, PMIs are economic activity surveys. And you can see on this chart, there's two types of PMIs, two main types of PMIs, manufacturing and services. The manufacturing here is the black line. And you can see we've had that many times throughout this bull run since 2009, right here, manufacturing activity contract. We even had a very similar situation back here in 1999 and in 2006, but none of these were closely followed by recessions. But what does systematically confirm the fact that we are indeed heading into a recession is the services PMI. You can see this brown line right here. It has only gone into contraction in 2020, in 2008, in 2001, and also briefly right here in 2003. And of course, these three right here, these three, 2001, 2008, 2020, and today, were also accompanied by yield curve inversions, 2000, 2007, and 2019 right here, in 2023, of course. So that's what we call the perfect recession trifecta. Not only is there a yield curve inversion, but also manufacturing PMIs are going negative and services PMIs are going negative. Now, the only logical question that is left to answer is whether a recession is already priced in through the price action that we had in 2022. Now, let me give you my opinion on that. You can do your own research to understand whether that's actually the case. But based on the research that we post on gameoftrades.net, we've done a lot of research on this. You can read through the macro notes that we've posted over the last month or so. We've laid out our entire thesis. You can go through it if you want to understand what the current macro environment actually looks like today from a data-driven standpoint. The only way that the market can rally much higher right now is if the recession, you can see the gray bar here, if that recession really only starts to appear later in 2023 and that the Federal Reserve announces a pivot and the market gets excited about that because inflation is coming down. That was our thesis throughout the second half of 2022. If you've been following us, you'll know that that's really what we've been highlighting as the reason for optimism in the market. And that could very well still happen. From a technical standpoint, we've broken out of this downtrend. So potentially we're seeing that thesis play out as we speak. So we're not trying to fight that, but that window of opportunity for stocks to really rally hard, which was wide open back in June, well, that's starting to really close now as we inch closer to a recession. Now, luckily, the SP500 isn't the only thing that you can trade as an investor. Our trade on copper miners right now is up over 20% since it was included in the model portfolio. And we announced that we wanted to make a bet on a falling dollar and the reopening of China. We identified the fact that copper miners were the best bet to make in that type of scenario, and that has worked out very well so far. That's what we do at Game of Trades. We know that individual investors who are investing on the side don't have the time to read incredibly complex reports highlighting opportunities like copper miners that give you an uncorrelated bet that can increase your potential gain substantially. Now, what's one proof that potentially we haven't actually seen the earnings contraction yet that could make the market vulnerable in 2023? It's the initial claims. The initial jobless claims have been trending down. The labor market is incredibly strong, despite the fact that the yield curve has inverted, right? You can see in previous inversions, the labor market starts to weaken. We can see that on this chart here. What happens to jobless claims after yield curve inversion? They systematically begin to rise. Why do they rise? Because we're heading into a recession. And in these cases, company earnings were going down. And so when company earnings start to contract, what do? Well, they lay people off to keep the company profitable. And that is represented in rising jobless claims right here. That's what typically happens after yield curve inversion. And we haven't seen that yet. So that is the proof that we have not yet seen the earnings contraction that typically follows a yield curve inversion, and that although we could see more optimism in the near term as that thesis of disinflation and the Fed pivoting and the market getting excited about that starts to play out, it's going to be a fake rally, because on the other side of that run, you've got a recession, you've got rising jobless claims and declining earnings that are going to start to hit the market in a big way. So I hope you guys did enjoy this episode. If you did, don't forget to smash that like button and of course subscribe subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.